Thanks everybody for having me. I'm going to be talking today about the Dairy Revenue Protection Program. Kenny did a really nice job of basically leading into this by talking about the futures and options market. So the Dairy Revenue Protection Program, it's a revenue protection program. It's got a lot of components to it that are very attractive. When he talked about LGM Dairy, that is a program that's also managed as an insurance program. So this Dairy Revenue Protection, DRP, is managed through RMA, the Risk Management Agency, very similar to LGM Dairy. But the difference here is the Dairy Revenue Protection uses multiple classes of milk price, and you cannot protect feed. So we're not protecting a margin here. What we're really protecting ourselves from is a decline in revenue price. We're setting that floor under our milk price using this. It actually uses, it's sold by the quarter. It takes an average of those 3 months in the quarter, and it's based off of those futures prices that are traded. It covers that, and it also has a little bit of an advantage that it can cover a decline in milk production, but that decline is in your pooled region. So if the region has a decline, it will assist with that decline in milk production. So there's a lot of different decisions you have to make throughout this program. As we go through, we're going to go through 7 different decisions. This is really just touching briefly on it to give you an introduction to what's going on in DRP. So if it's something that you're interested in, you can ask questions, investigate more, and learn about what's available. So it's offered through RMA. So if you have crop insurance, quite a few of the crop insurance providers in Ohio that I've worked with also offer DRP, but very few of them are highly versed in it. A lot of them have a few dairy farmers, they offer it, they have somebody on their team, maybe not your exact crop insurance agent, who can help you, or the larger umbrella they work under does offer this DRP program. So they can sell it to you. They may refer you to another one of their agents who knows a lot more about the program to help you through it. But in the regular crop insurance agent you work with may be your contact, and you work through them, or they'll just refer you to another agent. So some things that are offered, there's, depending on the company, that I find really handy is if they have a coverage quote tool that you can kind of utilize to look at your own operation scenarios as they go. And I really like the daily emails that give you an update on where market prices have moved to for each different category, and those daily coverage updates to kind of let me know what's going on, how prices have moved, and if it's time to start talking about pulling the trigger on purchasing a coverage option. So there's different levels of coverage. And those coverage options range from 95% to 80% of that futures price that you can cover. So and then you can also select amount of milk to cover. We'll get it to that on another decision here. But this is the decision of how much coverage from that futures quote price do you want to purchase between that 80 and 95%. And it's actually a subsidized program. So the premium subsidy goes down a little bit as coverage increases. So at 80% coverage, that premium subsidy is 55% of the cost. At 95% coverage, that premium subsidy is only 44%. And then this 95% is determining that trigger price. So when we look, on Friday I pulled Q1 2020 Class 3 trigger prices and net premium. So at 95%, that trigger price would be, and the trigger prices, it's a little bit of a confusing graph, but it was the best way to visualize it for me at least. Your net premiums are in blue, and the net premium amount, or no, net premiums are in orange, and that net premium amount is over on the right-hand side of your screen. And then the trigger price is in blue. So as you can see, the net premium obviously increases as we go back to that percentage of the cost that's covered by subsidy. The net premium increases as trigger price increases, but trigger price is also a lot closer to the actual futures price for the quarter as we go up to 95%. So we're at $15.80 for that trigger price, which is 95% of that futures price that was offered at the close of markets on Friday. And then as we decrease, you're down to about $15. This is using Class 3 futures, and we'll talk about the different options that are available for futures and blends here in another decision. But we're looking at that trigger price and what we need to cover. We go to 85%, that's going to drop it to about 14.25. And of course, premium goes down as percent of coverage price goes down because we're getting further from being in the money. We're further away from what that current futures price is. There's a less likely chance that the policy is going to have to pay out at a lower percent coverage with that lower trigger price. So we move into decision 3. So as we look at what we need to cover, we have that amount of subsidy. Then we have the amount of production to cover. So this is really designed to fit any size of herd. If we go back to when we were talking about futures and option contracts on the board, you needed 200,000 pounds of milk, I believe, for one of those contracts. These can be purchased to fit just about any size of herd, large and small, and it allows them to participate in the market. You can do much smaller contracts than 200,000. And things to remember that you can cover the production that you produce, but you can only cover the portion of milk once. So you can't do, when we start talking about a class 3 and a class 4 contract, if you only produce 200,000 pounds of milk in a quarter, you can't do a 200,000 pound class 3 and a 200,000 pound class 4. But you could do a blend of those and still utilize both classes. You do have some production obligations though. So if for some reason your herd's production would decrease based on what you expected it to produce and what you covered, if you choose the class production, which is class 3 or 4, you are obligated to produce at least 85% of that covered production. If you choose the components, which we'll get into a little bit more depth, but that's a fat and protein blend, you have to produce at least 90% of the pounds of components that you covered. If you don't, there's actually a reduction in coverage. That it's a fair reduction because you really didn't produce what you covered, but there will be a reduction in coverage due to that reduced production. So then decision 4 is when to purchase and what quarter to cover. So the market window for this program is after markets close. So for Eastern time, it's 4 p.m. to 10 a.m. Eastern is the window that you can purchase coverage in. And sales close 15 days before the quarter begins. So if we're looking at first quarter 2021 production, those sales are only going to be trading and available until December 15th. And then that will close and you won't be able to purchase that quarter of January, February, March 2021. It is available for up to 5 quarters at a time. Dairy markets are very thinly traded and not all options are going to be available. A lot of times class 4 coverage especially is not available for the further out quarters. There's a minimum amount of trading that has to happen each day for that quarter to be available. Most of the time class 3 is available in class 3 component blend. Premiums tend to be a little bit more expensive for those farther out quarters. So when you're looking at quarter 3, 4, and 5 away from where you're at, it's going to be a little bit more expensive. Getting into that type of coverage, and then we'll look at why we would select different types of coverage. But decision 5 would be the type of coverage. So what's available to you is class 3 and class 4 or a component blend. So in component blend, you can match what that component production of your herd is. It's a really attractive option, especially for our high component herds that are producing a lot higher fat and protein than that standard market 3.1 and 3.7. But the component blend, each one of these also trades differently. If you think about milk futures, class 3 and 4 move independent of each other. And the class 1 price is actually an average of class 3 and 4. It's a complicated formula I don't want to get into today. It's mentioned a little bit in some other of the price management, risk management webinars, so I won't go in depth on that. But your price is probably a blend of class 3 and 4 coverage, so you may want to use those in separate contracts because they do move separately of each other. But really, you want to look at selecting the best combination that matches your herd's production and those current market conditions and risks. Class 3 has really been a driver. We've been seeing class 3 continuing to drive up, and class 4, when we look at some graphs here in a minute, we'll see has been trending down on the futures. But when we look at comparing class 3 to component blend, here we have an example. So we have a revenue guarantee coming from class 3. We're going to do 5,000 hundredweights are going to be covered. The trigger price at the time for 95% coverage was $16.25, and we go with a protection factor of 1.5. The actual revenue produced on the farm, so class 3 prices had fallen at the end of the quarter to $16.15. The actual revenue was $121,125. I should grab a nice little highlighter here. There we go. The total cost, so the net premium for those 5,000 hundredweights to cover was $3,050. We did have a revenue loss, but actually that revenue loss wasn't enough to cover the total of the producer premium. So we lost on that type of coverage $2,300. We have a high component Jersey herd though, and we went with component coverage, and we covered 4 and 55.455% fat, and our protein average was 3.55%. So that's what we chose for our component coverage. We went with 95% coverage again. 5,000 hundredweights, our revenue guarantee, because we had that higher fat and protein production, was $148,500. Again, that 1.5% protection factor. Our actual revenue, our component price came in at $18.09. 5,000 hundredweights. Producer premium was a little bit higher because we were had that higher revenue guarantee. So we had $4,050 in that producer premium. But we look at our revenue spread. We take our guaranteed revenue minus that actual revenue, and our producer payment after paying that producer premium, $8,775. So the component coverage can definitely have a benefit on those high component herds that allows you to match what you're actually producing instead of just choosing class 3 or 4 coverage. And fat and protein are traded separately. So you may want to look at actually using a blend of class 3, 4, and component. Now I mentioned production factor in that example, and that might have started to confuse you. So the production factor is actually a multiplier. It ranges from 1 to 1.5 in 0.05 increments. It doesn't change the trigger price. So the trigger price is going to be exactly the same no matter what your protection factor is. But if the markets trigger, the protection factor actually increases the triggered revenue guarantee, but it also increases the premium. One way to kind of think of the protection factor a little bit is as basis. So if you start tracking commodity markets and you know what your farm's typical production is over that futures that are traded, what your price is, you can start looking at that spread, at that basis, and figuring out what your protection factor increase would need to be to insure yourself in the same way that wherever you're selling to increases your milk price. So when we look at the protection factor to try to help understand what that does, we're going to look at an example here with 10,000 hundredweights covered, and both of them we're going to have a 1653 trigger price, and we're going to have the same class 3 milk price of $16.05. We're going to compare a protection factor of 1 to a protection factor of 1.5. So both of these trigger because we have almost a 50-cent spread in between the trigger price and that class 3 milk price. Our costs, so our net premium with a protection factor of 1 was $2,700. Our producer premium, because we're insuring a higher value with that 1.5, is $4,000. But when we start comparing the two, with that large spread, we see that producer payment was $2,100 protection factor of 1 and $3,200 with producer payment protection factor of 1.5, and that revenue guarantee with 1 was $165,300, but by using 1.5, that jumped that revenue guarantee to $247,953. So it's a real multiplier factor that, if payments are triggered, can really improve the coverage of this program. So to look at this a little bit more, to compare protection factor, if first quarter 2021, again, these are the Friday's numbers. The trigger price on Friday was $15.80 with that 95% coverage. So we're going to keep our coverage at 95%. The revenue guarantee, the dollar value is over here on your right, and that's going to be the red line. And then the net premium is the blue. And the net premium values you can see over on the left-hand side. So with a protection factor of 1, that net premium is just a little bit over 30 cents. And we have that $15.80 coverage if we're triggered at that $15.80 level. With that 1.5 protection factor, it's going to cost us a little bit more. We're about 48 cents for the coverage, but it increases our protection. If the markets would fall and trigger that $15.80, our farm protection level then is all about $23.50. So it's a real multiplier. It continues on that gradient. You can see that the net premium flows very well compared to that revenue guarantee. Each time it increases about 2 cents. There's a small break in there where it increases only 1 cent. So this is where it gets messy, but I think to try to help understand the program, the messy graph here is important. So we're going to look at quarter 1 of 2021 versus quarter 3. They're not evenly pulled on the dates. I didn't keep enough emails of those trigger prices, but we're going to compare here late July to late November. So the yellow line here is quarter 2021 class 4 milk price. In July, I could have purchased a 95% trigger, and my coverage would have been $14.46 a hundredweight. Follow that same quarter 1 to November 19th. The coverage I could purchase on November 19th is $13.34. The futures market for class 4, quarter 1 has really been trading down, but really class 4 is in every quarter for 2021 has been trending down. So if we go up here to the dark red line, that is quarter 3 class 4 milk 2021. It's right around 15.45 that we could have done that July contract, and we're down to about 14.92. Now there's a lot of trading to go on yet for quarter 3, but those are really, we would have had to have paid a little bit more, and we'll see that in a minute for that premium. But the July, there were some opportunities back in July to potentially have locked in a little bit of a profit. Class 1 quarter, or class 3 quarter 1 is going to be this orange line. You can see that here in October, that really spiked. They were actually trading at really about the same value in July. And then in October, it spiked and it stayed above class 4 markets. But on the class 3 futures, if you're following those, the class 3 price really continues to go up throughout the quarter lately, which would cause this program not to trigger payments. And then we can look at these component blends. So we have the blue line, which is the component blend of 3.75 fat and 3.1 protein, so Holstein milk. It uses class 3 plus components, so it follows that class 3 price, but it stays above because there's really high value right now in protein is one of the drivers there. But our class 3 production, our class component blend for quarter 1, we could have locked in that 1709 back here in October, and that's fallen right now in November to 1637. So it's really important if you want to use these programs. The drive home message is that you got to stay on top of the markets. From month to month, they're changing. So when we start talking, Chris mentioned knowing your cost of production. That's really important for this program so you can start figuring out when to pull the first trigger. If you want to look at net premiums a little bit between each one of these. So Quarter one is always going to be closer than quarter three. So when we look at quarter one, which is in blue right here, versus quarter three of class 3 milk, and quarter three is going to be in gray. The further out quarters running a little more than 5 cents over. So right here's the gray versus the blue. We're running a little over 5 cents a hundredweight for that further out quarter for net premiums. As those two quarters come together, you can start to see, the closer you get, the closer those net premiums come to each other. Class 4, lower price, tends to trade a little bit lower premium. So really what brings it all together, and the way I kind of think about this when I'm trying to use the program to market milk, isn't just what is my break even. First, what is my break even price? But then if I'm using 95% coverage, I'm going to have that net premium, which the price has to fall below that net premium in order for me to have a positive return from purchasing the contract. So when I'm trying to set further out quarters, I start looking at what that spread is. And the dotted lines of that same color, the dotted line is the protected price minus the break even. So minus that net premium to get you what that break even is if the futures price would fall below that. So you can kind of see the spread between the protected price minus the net premium to give you that dotted line, which is the break even. But I like to set those at break even so that I can get that return if we're going to go ahead and purchase one of these contracts. I'm getting close to time, so I better speed up. Decision 7 is going to be when to pull the trigger on purchasing a contract. So Chris kind of covered that a little bit. You need to know your farm's cost of production, basis, farm price compared to the various CME, Chicago Mercantile prices that are traded. Different strategies are break even to avoid losses, above break even to lock in profits. And then there's always the strategy of there's nothing available at break even, but prices are trending down. So we can use it as protection from even greater losses. So a quick summary, the premiums are going to be due at the end of the insured quarter. That's a big advantage compared to using futures and options contracts and using puts or calls off of those. RMA is going to notify you of a probable loss. You can cover all or a portion of your production with multiple different contracts at different times. You just can't cover the same milk twice. Each quarter is going to be protected separately. So if you go back to the margin coverage program that Chris talked about, you cover an entire year. With DRP, you cover each quarter separately. The protection factor increases coverage, but also increases the trigger price. Each coverage type moves independently. So your class 3, class 4, and then your component blends all move independently. And there's a nice fact sheet with a lot more examples than what I covered, available at dairy.osu.edu on the current DIBs that were just released. And then it'll be archived eventually with the rest of the DIBs, which are dairy industry briefs, which will help lay out each one of these decisions in a lot more depth and detail to understand it a lot better than what I was able to cover today.